Good afternoon, ladies and gentlemen. We're going to get started. We're glad you could join us today for the latest installment of the Options Industry Council's webinar series. My name is Alexander, and I'll be guiding you through today's webinar, Volatility from Analysis to Execution. I'm pleased to introduce our presenter today, OIC's very own Joe Burgoyne, who is the Director of Retail Education and serves as a staff instructor for the Options Industry Council. He most recently served as Director of Business Development for derivative and data software company Volatility. Previously, he was Managing Partner of Burgoyne Capital Management, where he was responsible for all trading and risk management decisions. Also, Joe managed the floor operations at the Philadelphia Stock Exchange for Vandermeulen Options USA and Take Securities.
Alex, thanks so much, and everybody, thanks for taking time out of your day to join us. We get to talk volatility, and when you're talking options, there's no better topic, in my mind than talking volatility. Happy also to welcome Bill Ryan and Mark Benziquan from our investor services team as well today. The Options Industry Council, for those of you who don't know, is celebrating its 25th year this year. The industry leaders back in 1992 realized that investors, especially coming out of the '87 crash, where markets were down more than 20% in one day, industry leadership realized that the industry had to get out and maybe do a better job defining the risks and benefit of the listed options product, and the OIC was formed. So we've been lucky enough to be around for 25 years, and I've been privileged to be part of the group now for 9 years. These are the parent companies that make up the U.S. listed options industry. And for those of you who have heard me present before, this is one of my very favorite slides. It's a history of the industry going back to 1973. First options exchange was Chicago Board Options Exchange, founded in '73. We started with 16 companies back in '73 for the first 4 years. Some of you may know, the industry only had calls. The SEC didn't even approve puts until 1977. And you can see, as we go through, the decades of listed options business, it was kind of, we trudged along there for about 20 some odd years, but we got to the late 90s and a couple things happened. We got electronic access to the markets with the formation of the ISE exchange, and also we had dual listing, which gave the marketplace multiple places to buy and sell all listed options, and that had the impact of reducing bid-offer spreads. So the combination of reducing bid-offer spreads, more competition, and electronic access, you can see how option volumes surged from the late 90s into the early 2000s. And really over the last 4 or 5 years, despite historic low volatility, with the exception of the last 6 months, option volume has sustained in that 16 to 17 million contract a day average. And many of you may not know, 2018 has started out, ferociously from an options volume standpoint. The industry is averaging over 22 million contracts a day through the month of March. So that's about a 35 to 40% increase over year. So, huge volume. Of course, the volatility in the market is responsible for some of that. But also, what's responsible for that is a lot of investors like yourselves using options more frequently. Today, we will review pricing factors, all important, clarity between historic versus implied volatility, where we can find those important pieces of information. We'll go through some changing vol scenarios, practical examples. We'll touch on a couple strategies, and then we'll wrap it up. And all along the way, feel free to enter any questions you may have. So when we talk about volatility and risk, I think I get down to bullet number 3, frankly, and think in terms of where is a stock likely to be trading before expiration. Your volatility levels will help you to define that. What's the expected range of stock prices? And, from an options perspective, as we get to expiration, what options that I may be long or short might I possibly have the ability to exercise or be assigned on? That's really some of the questions that we should be asking ourselves when we think about volatility. Option premiums. We've got really a couple components when we talk option premium. We've got intrinsic value, and we'll review that. Because not all options have intrinsic value. And then we've got time value. All options have time value. Of course, if you're a day or two out to expiration, a low volatility stock, that time value is not going to be worth much. And if you have a really deep in the money option, chances are that time value won't be worth a whole heck of a lot either. So we've got, the intrinsic value and time value when we talk about options premium. Pricing factors that impact time value, of course, the time to expiration, the cost of money, and when we talk about cost of money, we talk about interest rates and dividend, and then the all-important, at least in my mind, all-important volatility aspect. So when we talk about these factors, some are known and some are really unknown. The time to expiration, obviously that's quantifiable. The cost of money, quantifiable, pretty close to an exact total. Then we get into this whole idea of volatility. And oftentimes that can be unpredictable. That's sort of what we're going to get talking about. One important aspect that people should understand about this whole idea of volatility is that it does not imply a trend. What it reflects is the fluctuation of the underlying, maybe to the upside, maybe to the downside, and over various periods of time. Volatility does not imply a trend. So many things related to, options and really investment, are common sense. And, here's one of them, higher versus lower vol. Obviously, you got a higher volatility stock, you're going to have a wider range of prices versus a more narrow range when it comes to lower volatility stocks. We want to be clear that everyone understands, and I'm guessing there was a solid 50+% of you who think about vol, so you know the difference between historic and implied volatility. But for those who don't, let's be sure we get that covered. Historic volatility is a statistical fact about how much the underlying stock, index, or ETF has moved in the past. Okay, so it's a mathematical calculation that tells you how much the underlying has moved. Okay, what it tells, and I like to think of it in terms of, I call it kind of the personality of a stock, the volatility. It's either a slow mover, a high flyer, or maybe somewhere in between. And historic volatility can help me to, define what kind of stock it is in terms of its underlying movements. And when we think in terms of what kind of stock it is, immediately we can start to think about, okay, high flyer or not, how many strike prices, might the stock go through over a period of time? They're the kinds of thoughts that I think are worthwhile to have as we think about our underlyings, the volatility levels, and, how many different strikes, a stock may move through over a given period of time. Does the personality of a stock, stay the same, month after month, year after year? Well, of course not. And actually, to me, that's where a lot of the fun comes in as we, start to talk about implied volatility, kind of anticipating how much movement the underlying will have going forward. Historic as well as implied volatility, where can you find it? Well, certainly you can find it on our website, optionseducation.org, your brokerage firm, various sites on the web. But, do be aware of what calculation of historic volatility you're looking at. Typically it's annualized, but, you can find it, on a weekly, daily, and monthly basis. So just, be aware of that. And if you're into the math side of things, you can calculate it yourself. Here is a typical, options chain. And, if you're like me, well, at least like me, maybe some years ago when I didn't quite understand the space, but, sometimes there's so many numbers in an options chain and on a platform, it can be overwhelming. I would urge you, get to understand, what these numbers represent on your platforms, because, these, small numbers, we've got Vega highlighted here, and it's 27 cents, which is honestly a high Vega number. That's going to be either an expensive issue, with a fair amount of time, in order to get a 27 cent Vega value. And what that means is if Vega goes, say, from 50 to 51, the value of your options is going to change by 27 cents. Again, that's not typical. That's a big Vega number, but it's important, to try to understand at least some of these numbers on your platform, the delta, the Vega, and then, of course, theta helps as well. Whether you're long or short options, going to tell you how much you should make theoretically each day, if you're short options, or pay if you're long options. Another, what I think is just invaluable resource that you can find at optionseducation.org are our volatility charts. You can find them all under the drop-down bar, tools and resources. It's about 2/3 of the way down on the left-hand side. It says historic and implied volatility. That's where you'll find the charts. To me, a picture or a chart is worth, far more than just words. We give you a 1-year snapshot of where the 30-day implieds have been. And as you can see, that dark line in the chart here is the historic volatility. And then we've got the overlay with the green line of implied volatility. So you can see the relationship, how that has moved over the course of a year. If you like trading vol, you can pay attention, obviously, to how much the vols move, in advance of an earnings cycle and an earnings announcement, and then, how much do they potentially collapse afterwards. So, those vol charts, if you've never used them, I would suggest, try to consider at least taking a look at them when you initiate a volatility position. Again, that's at optionseducation.org under tools and resources. I think we have 19 different tools and resources there now. I mean, you can believe me, there is much to learn with those tools and resources, but this one specifically are the historic and implied vol charts. Historic volatility and its potential effect on prices. This is a subtlety, but, the amount of movement in the underlying, that historic volatility, can increase and decrease without option prices changing. All right? It's not maybe that typical, but it can happen. You can have an increase or a decrease in that historic volatility measure without having a significant impact in, the option prices themselves. That won't be the case with implied volatility, which we'll, define here. Big difference between historic and implied volatility. Historic volatility is about the past, what has happened. Implied is all about the future, period. What does the marketplace anticipate for the underlying in terms of how much they expect it to move going forward? That is implied volatility. And, as I alluded to earlier, it's really where so much of the fun comes in, when we talk about options, anticipating, what the expected movement will be going forward. What's the relationship in the option premiums 1 month to the next, one strike to the next? I mean, we know how many strike prices are out there. Depending on your level of sophistication, maybe it's something that you really want to get, sink your teeth into. For others, and this is certainly just as important, just having a general sense of, what implied volatility is and how it impacts your options can be enough. We don't have to be expert in everything. So, the implied volatility chain, for each strike price, we're going to have typically a different implied. And as you'll see as we go, further out of the money, we get into a volatility skew. Implied volatility, a change in the underlying stock volatility, as I mentioned, may or may not, change the premiums in the option prices. But when you have higher implied volatility, okay, when the implieds increase, and we know there's historic volatility and there's implied volatility, but when the implieds actually increase, you will get higher prices in all your option prices. Higher call prices, higher put prices. Put call parity comes into play there. So higher implieds mean higher option prices. Lower implieds mean lower option prices. And that's how the game works. How to find, again, same thing, optionseducation.org through your brokerage firm, pretty straightforward. What can the effect of implied volatility be? What affects it? Basically, a lot of different factors. For those of you who are kind of close to the marketplace, overall market trends, can impact implied volatility. You get into a particular issue, a big order, in the call or the puts can definitely impact implied volatility depending on, the amount of liquidity in those underlyings. Common sense things like options or like stock fundamentals. Certainly rumors. I spent 23 years on the floor in Philly making markets and options, and rumors, if anything would get implied volatilities moving up and down, it would be rumors. That just, and the thing about rumors is, they're not really quantifiable. It's, and so, you can never be quite sure how far the implieds might go up versus come crashing down. So, rumors, were a big driver of implied volatility movement. Of course, earnings, I mentioned that earlier. The key with the various stocks that you may take positions in, I think, if you're talking about a volatility play about earnings is, looking at that movement, in advance of putting on a position, see when and or if the implied start to move. Is it 3 weeks, prior to the earnings announcement? Is it a month and a half? You put on a position, well in advance and actually get out right before earnings. That's where just doing your homework and thanks to the internet, you can do that homework now in terms of how to trade volatility, leading up to an earnings announcement. And it can really be challenging, rewarding, and a lot of fun. Other factors in terms of what can affect implied volatility, as I mentioned, overall stock market psychology, option volume. That really kind of gets back to the whole, idea of supply and demand. Big demand for calls is going to impact, implied volatilities, in your overall market. Rising markets or rising stocks, those of you who are in the space know that typically you get lower implied volatility, with a rising market or a rising stock. And, that comes from the belief that, things are, there's less fear, things are good, therefore, less potential movement, at least less risk, I guess. A drop in the market is when, you get a spike in implied volatilities, and that's how it works. Oftentimes, that spike can be awful quick, but it's a down market that'll typically give you your spike, in implied volatilities. Bottom line is, the market is a dynamic, living and breathing thing. There's new information every millisecond, and from day to day, different pieces of information impact the market differently. And, to me, that's just a great thing about, the markets themselves. Changing implied, is it good or bad? Well, it depends, frankly, what kind of position do you have on? You have a short vol position, a long vol position, that's going to define whether that changing vol is a good thing or a bad thing. Buyers versus sellers in terms of volatility, common sense. High vol, higher premiums, buyers pay more, sellers collect more. Low vol, lower premiums, buyers pay less, sellers take less. But again, keep in mind, lower vol, less chance, for a stock to move through strikes. Higher vol, you have a greater chance to move through strikes. Greater chance that something's going to be in the money at expiration, and then maybe you have a decision to make, whether you exercise or close out the position. Let's talk a little bit about implied versus historic vol. Well, an options implied return to the underlying historic volatility level. You saw that chart a little ways back where we had the black line being historic vol, the green line being implied. Sometimes, they cross over one another. The way the implied market works typically is it trades at a bit of a premium to historic. That's typically how it works. But, there's no guarantee that it's going to work that way later. I actually like to look at relative levels, in those charts. Is the low vol range, in the 20s and the high vol range in the 40s? If that's the case, maybe I'm initiating volatility positions, on the long side in the 20s, on the high side in the 40s, if in fact I'm trading volatility. Many folks, in fact, probably the majority of retail investors don't typically trade volatility. I mean, almost 50% of our audience today wasn't sure that they had a volatility position when you initiate an option position. Every time you initiate an option position, you have a volatility position. And if you're long options, you're long vol. If you're short options, you're short vol, typically. But as we go through the presentation, I'll get into some of those nuances. Should you be concerned about implied volatility? The slide asks. Well, concerned, maybe isn't the right word. Should you be aware of your volatility? In my mind, without question, yes. Because, volatility, from my perspective, is the key pricing factor, when it comes to options. And so, to not be aware of the key pricing component, when you're putting on an option position, I think is doing a disservice to yourself. But that's my take. Excuse me. Implied versus historic. Can they trade at a big variance? Absolutely. Is that important? Honestly, I think it really depends. That variance is typically going to be, implieds are going to trade at a large premium to historic. And when that's going on, I would say 9 out of 10 times, what's driving option premiums are rumors or an expected announcement. So then it gets back to understanding your position, understanding the risks in your position with a big move in the underlying, and then just, moving forward with a position. But that's trading. Expecting, implied volatilities change. I mean, they can change literally with one order. So they can change, immediately. I've seen it happen countless times on the floor for no apparent reason. Maybe the stock starts to move more, but that doesn't have to be the case. It's just really the dynamics of the options, the options world. So again, here is another snapshot of our implied volatility charts. Blue line showing historic, the gold line or brown line showing implieds. You can see typically implieds traded a premium to the implieds trade to a premium to the historic. And again, to me, I'm more interested in what's the general low range and high range of the implieds, and then I go about, maybe initiating a volatility position around those highs and lows. Let's take a look at a couple. I think we got 3 different, volatility examples. Number 1, changing implieds. XYZ deck 50 calls trading for $3. Stock's at $50. We got 60 days to expiration. Okay, so we're long the 60-day at the money $50 call for $3. Next day, stock's all over the place, but it levels off once again at 50, and those deck 50 calls are now, priced at $3.25. So, maybe because of the fluctuation in XYZ a day later, the call went from 3 to 3.25, even though the actual underlying price of the stock didn't change. So what is that suggesting? Well, the price is unchanged in the stock, and the call and therefore put prices are higher. Basically, it's very straightforward. The implied volatilities have increased. In this example, we're suggesting the implieds went from 35 to 40, and on paper we gained $25 for each long call that we owned at 3. It was now worth 3.25. Example 2, we buy again, so we're long the XYZ June 60 call, and we pay $5 for that. Again, 60 days to expiration, and it's an at-the-money call. Next day, stock rises $1 to 61, and the June 60 call actually drops from 5 to 480. Okay, so let's go through this. Let's talk about this, because if you're in the option space, you've probably seen this happen more than a few times. I remember when I started, using options, trading options, when this happened to me, I'm like, what the heck happened? Well, clearly what's happened is implied volatility. The premium has come out of these options. Go back to it, okay? 60 days to expiration. We're long the June 60 call. It's the at-the-money call, because you can see the stock's, $60. We pay $5. Well, when we pay $5, it would be a good idea to go check the implied vol charts. Does 5 represent, a low implied price, a medium implied price, or a high implied price? I don't know the answer to that, but we know darn well, the very next day, with the stock going up $1, we actually lost value, in those June 60 calls. So my guess would be that $5 price was either the mid to high level of implieds. Otherwise, even if they were on, the low side, we had vol absolutely crash, because let's go back to our initial position. We're long the at the money June 60 call. So what do you think? And I'm going to, move away from volatility a little bit here. What should the ballpark delta of the June 60 call be? Okay, it's at the money, so let's just figure it's a 50 delta. So the delta pricing component, or Greek option, would suggest that 50 delta option, with the stock going up $1, should go up $50, right? So that call, if everything else stayed the same, theoretically should have gone from 5 to 550, with the stock going from 60 to 61. I hope that makes sense. That's typically what should happen, but that's with all other pricing components, staying the same. Clearly, with the stock going from 60 to 61, and those calls actually losing, 20 cents or $20 in value, implieds got crushed, and therefore, we got a 480 price. And so, what's important, I think, as an option user, either as a novice or more experienced option user, and if you're more experienced, you probably already understand this, have a sense for what the premiums are, what the implieds are. So that June 60 call with 60 days to expiration is all-time premium. There's no intrinsic value there with the stock 60. So just have a sense whether that time premium, is at the low level, the mid level, or the high level, of its implied levels over the last year. And you can do that by checking out the charts at optionseducation.org. Okay, so again, you can see where that delta could anticipate what the value of the call would be, but then the implieds, and this is why I think the implieds are the most important pricing component when we talk about option prices. That implied wildly overpowered, the delta of that June 60 call. Example 3, okay, we write the XYZ SEP 80 covered call, all right? So by writing, that means we're selling an XYZ SEP 80 call. We buy the stock at 78 and sell the SEP 80 at $4. For those, who are new to options, stock 78, terminology for the SEP 80 call, it's out of the money, stock 78. The 80 call is where we have the right to buy or sell the underlying. So it's $2 out of the money. The value of that call is $4. Very next day, stock rises from 78 to 79, and the SEP 80 call drops to 380. Okay, so again, same situation. Implieds pretty much got crushed. It's not uncommon. If you go to the delta, that $78 stock, with the stock going from 78 to 79, was going to have less than a 50 delta, because those calls were $2 out of the money. Let's say a 40 delta. So you could expect that call to have gone from 4 to 440. Instead, it went to 380. So again, try to use those implied volatility charts just to have a sense for where your implied vols are when you initiate a position. It's none of us should be trying to pick bottoms and sell tops, whether that's with your underlying or your option trades. Just having a good sense of what's a midpoint, a high range, and a low range will really help you, in my opinion. All right, in terms of using implieds, what's the implied implying? Well, the implieds are always implying how much the market expects that underlying to move going forward. I mentioned earlier that maybe we'd talk a little bit about standard deviation. I'm going to go there just a little bit, hopefully not to lose anybody, but where I think using standard deviations can come in is assistance in trying to choose strike price, because there's nothing more important, maybe with the exception of implied volatility, in my mind when we talk about options, is the two questions: what strike, what month? And sometimes by analyzing the standard deviation movements in the underlying, it can help you to go in and choose a strike with your various option strategies. Again, just to emphasize, historic volatility, it's in the past, it's history, and that's where we talk about standard deviations, 1, 2, and 3 standard deviations. The implied volatility is the market's expected movement in that underlying going forward. All right, so when we get to looking to the future and volatilities, very simply, XYZ, $80 stock, we'll say it's got an annualized 30% implied. So what does that one standard deviation annualized really mean? You take that $80 stock, multiply it by the 30%, and it gives you a $24 move or a $48 range over the course of a year annualized. So we can expect on an annualized basis 68% of the time, because that's what one standard deviation represents, up to a $48 range, above and below, 24 above, 24 below that $80 stock over the course of 24 months. That's one standard deviation. So you're looking at a range, as the slide suggests, of between $56 and $104. you're going to be within that range, statistically speaking, almost 70% of the time. You get into 2 and 3 standard deviations, you're covering almost, 100% of the probabilities or possibilities, and you can see how those stock, ranges widen dramatically. But, in terms of, the formula itself, you take that annualized volatility percentage, divide that by the square root of time times the stock price. You can do that, in a quarter, a month, a week, a day. I think what's important is to decide what works for you. For me, I like the idea of annualized. I like the idea of a weekly, and then also a daily expected movement, the underlying, to help me understand, what type of movement I can anticipate in my underlyings. But again, that's something for each and every one of you to decide on your own. Just from a one-day perspective for you short-term traders, and if you're trading short-term, I'm sure you know this, you take that, annualized implied vol, divided by number of trading days, square root of the number of trading days times, the price of the stock. You get, the 30 divided by that square root, which is just under 16 times the price of the stock, and basically you come out with, on a daily basis, you're looking for, a range of about $1.52 in that underlying above and below. So, if you're trading real short term, maybe that can help you in terms of what options you want to be long and short. If you're a swing trader, gives you an idea how much movement you can anticipate. The reason I like the weekly and daily calculations for this kind of thing is, if I started to see those numbers change, clearly, there's a pickup, either, an increased implied vol or a decreased in implied vol, and that would certainly impact the value of my options, on a daily and weekly basis. So, that's why I like to look at those levels as well. Being aware of implied vol levels, that's what I've been harping on, I guess, for the last 35 minutes. Just if you don't incorporate those implied vol charts, try to get into the habit, because they'll become second nature to you. And then, when premiums get a little crazy on the higher low side, that's that's really going to become second nature to you. You're going to ask yourself, wow, these vol levels are at an extreme, and now, how do I take action, basically. We'll roll into vol strategy shortly in terms of taking action to the high side or the low side with vol. Buy low, selling high, that's the idea, but, at least we want to be aware of what low and high levels are. Again, there's that chart that we had earlier, the dark line representing historic vol, the green line representing those implied vols. And you can see, on the right side of the chart there, the implieds are lower than, historic. And that's why, to me, I don't really pay that much attention to the differential between historic and implied. I'm much more interested in the relative levels, the low side and the high side, and initiating positions around that. When we talk implieds, I mentioned earlier briefly, you get that market skew. As the strike prices go out of the money, the implieds will become typically lower. That may or may not be meaningful to you. Typically more meaningful is the month-to-month deviation in implieds, those months that incorporate, earnings announcements, especially, in stocks that may be surprised with earnings from time to time. You're going to get, definitely a bump in implied vols, and that's why you want to always be aware of that earnings situation. So, just generally, from a strategy standpoint, the impact of implied volatility that it has on our option positions. Obviously, long option positions are the ones where we're going to be interested in implieds that increase in value. So no matter what the underlying's doing, if the implieds are going up, as I mentioned earlier, because of put-call parity and the relationship between the stock, the put, and the call, if implieds are going up, that means the premiums in both your calls and your puts are going up at the same time. So what kind of positions would that be? And well, before I go there, I guess, on the flip side, the short positions are going to be those positions where, we obviously are looking for implieds to decline. But that doesn't mean that, to have a short volatility position, you have to be short options. And this is a presentation on implied volatility, and therefore, risk of option pricing is kind of how I like to think of it, when we talk about implieds. But first and foremost, always, is what is my risk in the overall position? That's key. I mean, you may have, an underlying position and some short calls. You may have an underlying position and some long puts. You may have a massive options position. But most importantly, know the tail risk. How much money can you potentially lose if something crazy happens to the upside or downside? That's what you always need to keep in mind first. What's my ultimate risk? And, inside of that, implied volatility, will be a big factor. But that implied, you can be short implieds and net long options, no problem. There are lots of position types where you can be short implieds but net long options. So that's why, look at risk first and analyze that overall, and then narrow down, is my risk in delta? Is it in, gamma? Am I net short options? So if something, massive happens to the underlying, that negative gamma is going to, really hurt me badly. Is my implied volatility position, so large either on the long or the short side that I'm drastically impacted, if it goes the wrong way? Looking at overall risk is where you really always need to start. And then, the point here is be aware of how you can quantify that implied volatility risk. And, I'll just go back to that slide where we had the options chain and we highlighted implied volatility at 27 cents. That quantified the value of that particular option, inside of the position. The platforms these days do a spectacular job, quantifying our various risks. Just be aware of them, especially when the underlying moves, in a large way. So, getting back to, the implied effect and the various strategies, again, you don't have to be net short options to be short volatility. On the long side, clearly long straddles and strangles, we're going to want implied volatilities up. A straddle is where you are long, typically the at-the-money call and put. The strangle is typically the out-of-the-money call and out-of-the-money put. Both of those positions are inside of the same month. So, clearly, net long calls, net long puts, if premiums go up, which is the impact of implied volatility, you're going to be making money with or without movement in the underlying, okay? Because, again, implied volatility is its own pricing pricing part, if you will. And so the underlying actually doesn't have to move to make or lose money with implied volatility. Aside from, the straddles and strangles, back spreads, and a back spread, let's just take a $50 stock, a put back spread would be short, typically the at the money put, so short the 50 puts and long the out of the money or 45 puts in some kind of ratio. So your net long options. Depending on that ratio and depending on the price of the underlying, you will, if the stock takes off to the upside, you're going to have less of a volatility position. So, that back spread may not work a ton for you. But if the underlying moves down towards that long 45 put strike, you're going to pick up vega, and even through the strike, implied will work for you in that case. So, long straddles and strangles, back spreads, some other spreads that I don't have on the slide, but I'll include. The calendar spread or time spread. Let's go back to that $50 strike. We buy time in a calendar or time spread. So, maybe we buy July and sell May. There's more vega, and I actually didn't mention this yet. The further out you go in time, the more vega an option has. So anytime you're buying time in a position, you're going to be long vega. And so a calendar spread would be an example. A diagonal spread typically will be long vega because of a diagonal. If we're long the diagonal, the way I think of diagonals, typically you're long, a somewhat, it doesn't have to be in the money, but it oftentimes is an in or at the money. It's certainly an in the money strike more so than the front month or closer to expiration diagonal call or put that you're selling. So, those diagonals typically are long vega, and where you're long time and short the front month trying to, make money off of the decay. So typically that's a long volatility position. Leaps, long dated options, beyond a year and a half. That's really where vega comes into play. A lot of people, consider buying leaps because of the efficient use of capital, buy in the money leaps and sell, front month, at or out of the money calls, to offset the time premium in those leaps. That leap diagonal is most certainly a long volatility spread. And I always, whenever I'm talking to people about leaps, please be aware of the volatility level in any leap that you buy or sell, because there's so much time premium associated with a long-term option, and that time premium by and large is defined by implied volatility. So straddles and strangles, back spreads, calendar spreads, diagonals, and leap strategies, all want implieds up. Implieds down are going to be the opposite side. Short straddles and strangles, obviously, but when we talk short straddles and strangles, we're talking major risk. And as I was emphasizing earlier, the first thing to always be aware of is your tail risk. If that underlying moves big up or down, am I going to get hammered? You got to know the answer to that question. Short straddles and strangles, yes, you're going to make money if implieds are down, but if that stock moves in a huge way up or down, you stand to take a big loss. So, looking at a credit spread or something like that, may make a heck of a lot more sense rather than just short a straddle or strangle. Getting into, a butterfly or a condor, would be something to consider there to minimize your risk. Ratio spreads unlike the back spread is where you're net long options. The ratio spread is when you're net short options. So, maybe we've got a $50 stock, we're long the 50 calls, and on some ratio beyond 1-for-1, we're short the 55 calls. Excuse me. That's a ratio spread. But again, when we talk ratio spreads, we're talking net short options. Net short options leads to, extraordinarily large risk beyond a certain point. So be aware of that. Another thing to keep in mind, if you're talking about, a short volatility position, as I said, if you sold, longer dated options and bought front month or, more recent dated options, doesn't have to necessarily be the front month, but it could be maybe you're selling, 8 or 9 months out and buying, 3 or 4 months out on a diagonal in a calendar, something like that. That's definitely going to be a short volatility position. But again, that's where being aware of what the implied volatility levels are from month to month is important. Oftentimes, the marketplace will discount implied volatility as you go out in time. So, to me, it's part of the interest in trying to win in the option space, analyzing the different relationships between, the various options, and then putting on positions, that can, make you a good return. So there, some options positions that typically will look for implied volatilities to come down. This slide, basically just really talks more about the flexibility, 18 different position types, the majority of which chances are you'll never need, but, options, do offer flexibility. And, I guess what's important to me in this slide is the tails of these 18 different positions, the blue lines, you've got, a midpoint between, where these positions are put on. But then what happens to your implied volatility positions, with a particular position when the underlying moves? Check out the, the different tools that are available for you, position simulators, from your brokerage houses that you can move, the implied levels. You can move, volatility levels, the implied levels, but more importantly, maybe move the price of the stock and the days to expiration and see how those implied volatilities change and how your P&L changes. So just to wrap it up, maybe we got a couple questions, Alex. Let's see, I think we pretty much hit on things, just be aware of the implied levels. That's all I would urge you, not that you have to be an expert, but just try to be aware. Again, when establishing a position, have a sense for where the implied levels, and that basically, when we talk implied levels, and, some people think maybe that's a little intimidating, where have the premium levels been in the past? Last bullet, expect the unexpected. That's what I'm talking about when I say, know your tail risk in any position, please. That first bullet here, the whole idea of math and statistics, I think the vast majority, who have investments, math and stats aren't necessarily their things, but for those of you who like it, consider those standard deviation calculations to help you define, some maybe, some of the strike prices that you want to initiate positions. Better understanding of vol, is going to help you better understand how your options move. Before I turn it to Alex, I will just say, if you're new to options, on our website, optionseducation.org, we've got that great MyPath program, part of the options education program. You go into our site, you take a 20-question assessment test, and based on the results, we'll download lots of option questions or options lessons for you based on the results of those that assessment test.
So ladies and gentlemen, thank you for your time today. While we weren't able to get to all of your options questions, we have our investor services team ready to help. Feel free to reach out to them at options@theocc.com. Again, that's options with an S at theocc.com. Or you can click the Contact Us widget icon for ease. You can also access our webinar for next week, in which we will build off of today's topic by facilitating a discussion with industry experts on how they incorporate volatility in their trading decisions. Many of you asked about further education. Please visit optionseducation.org and see the Getting Started section for further reading. You can also access OIC's MyPath assessment to gauge your options knowledge and receive a customer learning experience for you to advance your investing skills. And of course, make sure to check out the website for upcoming events. You can find a link to our website in the additional resource section. I mentioned our webinar next week on volatility, and we will be reviewing put-call parity next month. In addition, our live seminar program has begun, and registration for our Illinois and New York events are open. Be sure to go to our homepage to see how you can take advantage of options learning experience how to take your options learning experience to the next level. And with that, thank you for attending, and we hope to see you next week.